Hello and welcome along to the Property Academy podcast by Opus Partners. I'm your host, Stephen Knight.
I'm Andrew Nicol.
And today on the show, we're talking about what's a good gross yield. Now, I get this question all of the time. People say, what's a good gross yield in today's market? And when you see this asked online, a lot of people say, well, it depends. It depends on your strategy. It depends where you buy. It depends. And you often don't get a straight answer.
You
the reason
hate that,
is,
don't you?
I don't like fluffy answers because people just want to know what is a good gross yield. But it is really hard to calculate. And so I've got some new data for you. What we've done is we've scraped TradeMe looking at every single property that is currently available for rent on there. And then what we do is we go on OneRoof to get the value. Now, what that lets us do is calculate the gross yield. So I'll give you an example. There is this property available in Melville, Hamilton, 3-bedroom property, 90B Tower Street. And it's currently online for $530 a week. So, yep, cool. Pretty standard rental property there. Then what we do is we go on OneRoof and get the OneRoof estimate. Now, they say that property is worth, $540,000 today, right now. That gives it a gross yield of about 5.1%. And so you say, okay, well, that's 5.1% for that specific property. How does that compare to the rest of the market? Well, what I do is I then get a computer to go through and do that for every single property. In this case, I've just done it for Hamilton. And all up, there are about 300 odd properties available online. And I've been able to get good data for about, I think it's about 160 odd of them, because sometimes you get things like a 6-bedroom property, they're just renting out by the room. So, that would look like the rent's $230 a week and the value is $1.2 million. So we do that lots and lots of times, and then that gives us an understanding about what yields people are willing to accept.
And so, Ed, what do you see from the data?
So when I look at just Hamilton, I'm only looking at Hamilton for now, the most common yield is between 4.2 and 4.4%. So of the properties I got data on, 21 properties available on TradeMe today, September 2023 in Hamilton, have a gross yield between 4.2 and 4.4%. But there is a real distribution. Some properties have a higher gross yield than that. Some properties have a much lower gross yield than that. But what you could say is, look, if you have a rental property in Hamilton right now, and the gross yield, the rent multiplied by 52, divided by, you'd think I'd get that right, actually, by 42. No, but rent multiplied by 52 divided by the current value, if that's between 4.2 and 4.4%, you're in good company. That's a very popular one. But some properties have other gross yields much lower than that. So I've been looking at this property. It's on Garrick Place in Hamilton in Beers Court.
So a much nicer looking property than the previous rental?
Yeah. This was probably bought as a new build, 500 or recently built. Currently renting for $640 per week. That's what it is advertised for. And if you look at the OneRoof estimate, they estimate it's worth about $1.1 million today. The RV's a bit higher than that. So that suggests a gross yield of 3%. So that's down the other end of the spectrum. So the first property we looked at had about a 5.1% gross yield. That puts it at the upper end of what you'd expect. This one we've just looked at, about 3%. That's at the lower end of what you'd expect, and kind of something starting with a 4 is around about in the middle. But let's answer that question. What is a good gross yield for Hamilton right now, September 2023?
Okay, so the median gross yield is 4.46. So call it 4.5. So if your gross yield is more than that, the 4.46, then you're in the top half of properties as far as yields go. Now, if you're less than 4.46, you're in the bottom half of what property investors are willing to accept right now.
So if you're going, hey, what's a good gross yield? 4.46, that is right smack bang in the middle of what people are actually willing to accept. And so the great thing about this is it's not based on what we think. It's not based on what we're necessarily getting. We might get something higher. But that is what people are willing to accept in Hamilton today.
Now the interesting thing is it drops down quite quickly. So if you go to 4.12 or less all of a sudden now you're in the lower 25% of investors.
That's right. So now instead of saying, am I in the top half, am I in the top bottom, let's talk about, what would be a bad gross yield and what would be a good gross yield. So if you are 4.12 or less, you are in the bottom quarter of property investors in Hamilton right now. So that one on Garrick Street, I think it was Garrick Place that we just talked about, 3% gross yield, they are in the bottom 25% of investors currently on the market in Hamilton. But let's talk about the other way. What would be a really good gross yield in Hamilton? What's the top 25%?
Yeah, so if you're above 5% or 5% or above, all of a sudden you're in the top 25%. So it's funny how there's a couple of outliers there in your graph, though.
Well, not necessarily outliers, they're just high yielding properties. So there is one that's currently, the data suggests, has got a gross yield of about 7.6 to 7.8%. Another one kind of 6.4 to 6.6%. But those are the very top. Most properties we're seeing are somewhere between 5 and kind of 6% at that higher end.
So rough numbers, if you're at 4.5% in Hamilton right now, you're about the middle of the pack. If you're dropping below 4, then you're at the lower end. And if you're above 5, you're at the upper end.
I think that's probably fair enough. If you're between 4.1 and 5%, then you're in that middle 50% of property investors, and you're probably doing okay. If you're below that, then you're probably look to either increase the rent on that, or you might say, is that really the right property for me?
Now, Ed, one thing I picked up on, you were talking about the value. Now, I know a lot of investors focus on what they paid for a property. So they might have paid $300,000 for the property 20 years ago. And so when they calculate yield, they work on the purchase price because that's what their mortgage is. That's what they paid for it. What do you think about that?
Well, we also see that a lot with renovators. So you might buy a property today in Whangarei for $400,000. You spend 50 grand renovating it. Now it's worth $550,000, but they calculate the gross yield on 450K. I think that's the wrong way to do it. And the reason for that is you've always got to think about what is the yield I'm getting on my asset's value. Because you've always got to think, well, I could sell that property and go and do something else with it. Now, if you're renovating and selling straight away, of course, there are tax issues. You've got real estate fees and things like that. But you should always do it on value, because the question is, what is the yield on my asset's value? Because you could always go and do something else with that asset. You could sell it and do something else. And I'll give you a really good example. Just ignore Brightline, ignore real estate agents' fees for the moment. Let's say that you had... you got the unicorn deal of the century. You bought $1 million property for $500,000. Really good deal.
It's a very good deal.
Not going to happen, but I want to use this to illustrate my point. And let's say that you get $30,000 worth of rental income. Well, if you are calculating the gross yield based on what you paid, you'd say, I've got a 6% gross yield because I've got 30K coming in and I only spent $500,000. You'd say, that's very good. If it was at Hamilton, I'd be right at the top. I'd be extraordinarily happy with that. But actually, the value of your asset is $1 million. So you don't have a 6% gross yield. You've got a 3% gross yield, in which case you'd say, now I'm all of a sudden down at the bottom of the pack. I'm not doing as good as other property investors. And the reason you want to think that is you might be able to sell that $1 million property with the same disclaimers I gave before about Brightline and things like that, and then you'd be able to buy something, say, with a 4.5% gross yield. Now, rather than getting 30 grand worth of rental income, you're getting 45 grand worth of rental income. And so it's always about, well, what is the yield I get from the value of my asset, because I have other options, because I could then go and do something else with that money. I know it's not the way everybody does it, but I believe that from a finance perspective, that is definitely the way you do it, so you can make the best decisions.
Well, I just think when you're assessing your portfolio and doing your personal annual review or doing it with a financial advisor or whoever you do that with, it's important to always look at that value, because that is the true reflection of how your portfolio is going, not what growth has already occurred.
Well, simply, that's why some investors might look at this graph and say, well, hang on, I'm getting an 8% gross yield on my investment property. Well, you might be getting 8% if you're only including what you spent to buy the property plus your reno costs. But if you look at the value, often your gross yield is a bit lower. It might be around that 6% mark rather than the 8% mark you think, or the 10% mark. Now, we should also mention as well that there are some limitations to the startup. So addresses don't always match up. I'll give you a really good example. Often when we're scraping Trade Me, I'll find an example that's really, really bad. 32H Abbotsford Street, Hamilton City. When my computer went through and scraped it, it looked at 32H McBride Street, and it's actually look at Queenstown. That's a really bad example. That's why I've got an algorithm that gives me a percentage of matching up. So I don't include that in my analysis because, hey, it hasn't matched. If I look at a slightly better one, I'll find one for you. 520 RMC Jones Crescent Melville. Is that the same as 5/20 Jones Crescent Melville? I don't know, so I've kept it out of my analysis. So that does mean that while I might scrape 300 addresses from Trade Me, I only use maybe half of them or 40% of them in my analysis. I expect that that sample is probably a representative sample, so I still feel pretty good about that. The other thing that's probably important to note, just in terms of these limitations, is that one roof is not always going to be an accurate value. We know that if you think about homes.co.nz, often there's only a 1 in 2 chance that you get within 10% of what home says. So for example, let's say homes.co.nz says your property's worth $1 million. You've only actually got a 50% chance that if you sold that property, it would go for between 900,000 and 1.1 million. So it's not completely accurate, but this is the best data that we've got. And actually, I've never seen anybody else do this kind of analysis and say, well, what are property investors willing to accept today? Not what they tell you that their gross yield is, but if you use a consistent basis for measuring properties, then what is the gross yield? And the answer is about 4.5% in Hamilton today is the median. Somewhere between 4.1 and 5% is probably quite good. And we might do an episode in the future or write some articles, Andrew, looking at the whole country. We've chosen Hamilton here because it's kind of a good middle of the road city. It's not as expensive as Auckland, but it's still a main centre. It's probably, you'd see the same distribution wherever you look at the country where you've got a lump in the middle. Some investors are doing better, some investors are doing worse. Anything in this surprise you, Andrew?
No, not really. I mean, I think the number that's probably there as the median is maybe a little bit lower than what I was maybe expecting for, once you lump all the older properties in there.
About 4.45% as a median. I remember when I ran this analysis for Auckland, probably about 2 years ago now, the median yield was something like 3.5%. I'd expect that will have crept up now as values have come back, rents have gone up. But that's why it's important to always look at this and just have a think. If you own a property in Hamilton and you take your current rent and what the value says on one roof and it's sitting at about 3%, you probably want to think about that property. You are in the bottom 25% of property investors right now. And I will keep updating this and, we'll look at other cities as well in the future once I get that data sent to me. But I really like using Hamilton as a middle of the road city. Right, let's wrap it up there. But please don't forget to rate, review and subscribe to the podcast. Really does help us get the message out for more people. And hey, if you're listening to this on your podcast app, you might want to see the visuals behind this, the graphs. Well, you could do that. Just Google Opus Partners YouTube. It'll be the first thing that comes up. And if you're on YouTube, make sure you hit the subscribe button. Really helps us grow the channel. Thanks for listening to the Property Academy podcast. I'm your host, Steve McKnight. We're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.